Hello, and welcome to this video, where we will be discussing the topic of why taxing the rich never works. Taxing the rich has long been touted as a solution to address income inequality. But is it really effective? In this video, we will be exploring the reasons why taxing the rich is not a solution to income inequality and the potential consequences of this policy. So sit back, relax, and let's dive into the world of taxation. Capital flight. One of the biggest drawbacks of taxing the rich is that it can lead to capital flight. High tax rates on the wealthy can make them move their money and businesses to countries with lower tax rates. This leads to a decrease in government revenue, as well as a loss of jobs and economic growth in the country. For example, in 2012, France increased its top tax rate to 75%, causing wealthy individuals and businesses to flee the country, leading to a decline in economic activity and government revenue. Disincentives for entrepreneurship. Another reason why taxing the rich is ineffective is that it creates disincentives for entrepreneurship and investment. High tax rates on the wealthy can discourage them from starting new businesses, investing in existing ones, or expanding their operations. This, in turn, leads to a decrease in economic growth and job creation, which can harm the overall economy. A decrease in entrepreneurship can also lead to a decline in innovation and technological progress, as entrepreneurs are often the drivers of these advancements. Tax evasion and avoidance. Taxing the rich can also lead to tax evasion and avoidance. Wealthy individuals have the resources to hire lawyers and accountants to help them find ways to reduce their tax liability. This leads to a decrease in government revenue, as well as a loss of fairness in the tax system. When tax evasion and avoidance become widespread, it can also lead to a decrease in public trust in the government and the tax system. Political difficulty. Taxing the rich can also be politically difficult to implement. The rich are often well-connected and have the resources to influence politicians and the media. They may use their political power to prevent tax hikes or find ways to reduce their tax liability. This can make it challenging for policymakers to implement effective tax policies that benefit the majority of the population. Ineffectiveness in reducing income inequality. Despite its good intentions, taxing the rich has never been proven to be an effective means of reducing income inequality. In many cases, the wealthy are able to avoid paying their fair share of taxes, and the money that would have gone to the government is instead kept in offshore accounts or invested in tax-free assets. Additionally, the wealthy often have the resources to lobby for tax breaks and loopholes that benefit them, further reducing the effectiveness of progressive taxation in reducing income inequality. Decreased competitiveness. High tax rates on the rich can also reduce the competitiveness of the country's economy, leading to a decline in foreign investment and job creation. When businesses and wealthy individuals see that their tax burden is too high, they may choose to move their operations to countries with lower tax rates, taking jobs and investment with them. This can lead to a decline in economic activity, reducing the competitiveness of the country and making it less attractive to investors and businesses. Unintended consequences. Taxing the rich can also have unintended consequences. For example, wealthy individuals may choose to invest in tax-free assets, such as real estate or offshore accounts, reducing the government's tax base and revenue. This can lead to a decrease in public services and increased public debt, making it even more difficult to achieve the goals of progressive taxation. Reduced consumer spending. The rich are often significant consumers, and high tax rates can lead to a decrease in their spending. This can have a negative impact on the overall economy, as consumer spending is a major driver of economic growth. When the rich are taxed at high rates, they may choose to reduce their spending, leading to a decrease in demand for goods and services. This, in turn, can lead to a decline in economic activity and job creation, as businesses may be forced to reduce their operations or close their doors due to reduced demand. Increased bureaucracy. Implementing progressive taxation often requires a complex tax code and an increase in government bureaucracy. This can lead to higher administrative costs and a decrease in efficiency, as more resources are required to implement and enforce the tax system. Additionally, a complex tax code can make it difficult for individuals and businesses to comply with the tax laws, leading to increased confusion and the potential for increased tax evasion and avoidance. Unfairness. Progressive taxation can also be seen as unfair, as it places a disproportionate burden on the wealthy, who already contribute a significant amount of revenue to the government through other taxes. The wealthy may feel that they are being unfairly targeted and may choose to reduce their investment and spending in response, leading to a decline in economic activity and job creation. Additionally, the rich may choose to invest in tax-free assets, further reducing the government's tax base and revenue. Lack of simplicity. The complexity of progressive taxation can make it difficult for individuals and businesses to understand their tax obligations, leading to confusion and errors. The tax code may become more difficult to administer and enforce, leading to increased compliance costs for taxpayers and the government. This can lead to frustration and decreased trust in the government, as taxpayers feel that they are not getting a fair deal. Reduced foreign investment. High tax rates on the wealthy can also discourage foreign investment, as investors may be hesitant to invest in a country where they face high tax rates. This can lead to a decrease in economic growth and job creation, as businesses may not receive the investment capital they need to grow and expand. Additionally, the lack of foreign investment can reduce the competitiveness of the country, as other countries may offer lower tax rates and a more welcoming investment environment. Encouragement of tax avoidance. Progressive taxation can also lead to increased tax avoidance and evasion, as individuals and businesses seek to minimize their tax liabilities. This can lead to reduced tax revenue for the government, as taxpayers use legal or illegal methods to reduce their tax obligations. The government may then need to increase its enforcement efforts, further increasing its administrative costs and diverting resources from other important priorities. Reduced motivation for entrepreneurship. Progressive taxation can also reduce the motivation for entrepreneurship, as high tax rates may make it less attractive for individuals to start and grow businesses. Entrepreneurs may choose to pursue less risky and less lucrative careers, leading to a decline in innovation and job creation. Additionally, high tax rates on business profits may reduce the incentive for businesses to invest in new technologies and innovations, further limiting economic growth. Thank you for joining us on this video, where we discuss the topic of why taxing the rich never works. We hope that you found the information in this video helpful and informative. Taxing the rich may seem like a simple solution to address income inequality, but it is not without its challenges and drawbacks. If you have any further questions or comments, feel free to leave them in the comments section below. Don't forget to like and subscribe to our channel for more informative videos like this one. Thank you for watching.